Good morning. Good morning. Good morning. Esther Naipanoi. Good morning. Rodini Azizi, good morning. Good morning. Karimi, can you hear me?
Yes.
I just needed that confirmation that I'm being heard so that we start.
You're audible.
Okay. Well, our topic today is on the central bank's supervisory role. And the central bank has been following a supervisory framework called Camel. And it is really the risk-based supervisory framework, which allows now the central bank to deliver consistent and high-quality supervision as the financial sector develops. And of course, as the risk profile of the financial institutions change due to macroeconomic factors. For example, competitive forces. So the enhanced supervisory regime will promote the competition, of course, safety, and also the soundness of the financial sector. And of course, the approach will benefit institutions as the regulatory effort is focused on high-risk areas. And of course, it provides for more efficient supervision. So that is why we have Camel. And Camel traditionally has been used to rate or to determine the institution's financial condition. And the acronym, as you can see there, that is everything. C stands for capital adequacy. A stands for asset quality. M stands for management, but I've decided to add soundness because most institutions are going down because of corporate governance issues. Then we have earnings. E is for earnings, but I've added profitability because earnings is more or less based on the profitability. For the bank to be able to declare dividends to its shareholders, it must have earned that profit. Then we have liquidity, and the last one is sensitivity to market risk. Now, this composite or the Camel rating is a combination of now the six ratings, and it is achieved on the individual institution. Or I can just say the composite Camel rating, the combination helps now to rate the particular financial institution. So it is individual and also composite. The rating is either, or once the six components are put together, they will help now the central bank officers to rate that particular financial institution. And we basically we have five ratings. The first one is strong, or rating number one is strong. When the bank has met all the 6 areas or has performed well in all the 6 areas, we call that a strong bank. Now the second one is satisfactory. So when the bank is rated as satisfactory, it means that they are more or less above average, and they are performing well in most of the areas. Then the third one will be fair, when the bank is average, marginal, when the bank has some gaps, and then the last one and the most serious is unsatisfactory. So these ratings are compiled per month, and they are compiled on what we call the off-the-site supervision. Of course, the bank has set some of its indicators, and they can easily detect if there is capital inadequacy, if the assets are malfunctioning, if there are issues with management. Of course, that one you cannot hide. It will be in the public knowledge. So a bank that has been rated as strong, it will be having the highest and the best rating. And of course, it means that its supervisory is okay. If you go to other territories, and there are these people I'm trying to admit, don't know why Zoom has decided to queue my participants in the waiting room. Of course, it is in line with the discipline. If you are late for this class, you might end up being locked out. So I think they updated their settings now for the Scholarly app. So we go on. I was saying, if you go in some territories, they call it Camel. Camel, by removing M. We are calling it Camels because of the M. So if we remove M for the management, and the rationale is the M rating is influenced by the same factors that are used to determine the quality of risk management. So if we have an adequate board or senior management that oversees the running of the particular financial institution, we don't expect to have the other gaps, either in capital adequacy, in asset quality, in the earnings, in the liquidity, and the sensitivity. So they ensure that the board and the senior management oversees all the other aspects of the Camel component. Then, of course, we have adequacy of policies or the procedures that ensures that every bank is in compliance to make sure that there are no deficits in the areas. Of course, a good management will also ensure that they have established procedures that are comprehensive and enhances internal control. Now, if a bank is able to manage its welfare or its activities well, we don't even need to have the indulgency of the risk-based supervisory aspect of the central bank. It is automatic. And if you look at the best performing banks in this country, they've been scoring so well, especially in the management or in the governance issues. A good example of them is KCB. We have Joshua Oigara, we have Equity Bank, we have James Mwangi, we have Cooperative Bank led by Murioki. So we have these banks that we know that their management is so sound You don't expect any gaps in the compliance. And if you are able to detect at the early stage that there is any risk that will hit us, then the management will be able to come up with a mechanism of controlling it. Now, the first aspect is the capital adequacy. Now, to protect the interest of the depositors, as well as those of the shareholders, central bank introduced what we call the risk-based system. And this is to ensure that we have adequate capital at all times. So banks are required to raise a minimum of 8% capital to risk-weighted assets. And this is a ratio that is normally used by central bank to evaluate. And they can easily tell even off the site. You see the bank of the other banks. So if you are unable to deposit this amount, of course, the bank will know that you are already in the red tape or you are malfunctioning. And they are going to detect and they are going to try and understand the situation before it gets worse. So from 2007, banks are required to raise a minimum core capital of 2.52 million US dollars. Now, depending on which tier of the bank, it ranges between 2.52 million to 10.1 million for the tier 1 banks. And this was set in 2012, and there was a deadline of December 2012 to ensure that all the banks comply. The reason why they came up with a very harsh mechanism, they realized that most banks are unable to play about this ratio. And when it hits them, it is central bank that is left at the verge of losing, because we know that it is the banks of the other banks. And being the bank of last resort, it will come in and bail out that particular bank that is already suffering. So before we put you under receivership or Kenya Deposit Insurance Corporation to ensure that the shareholders or the depositors will not lose their money, the bank has already made sure that you've deposited quite a substantial amount of money that will cushion you against any uncertainty that may arise without you detecting. Of course, we saw some banks were put in receivership. We had Dubai Bank in 2015, Imperial Banks 2015, Chase Bank followed suit in 2016. And to prevent this, of course, central bank had to make sure that the rules are really tight. So when you are talking of the capital adequacy, you really have to meet the required standard. We've said it is 8% of your capital to risk-weighted assets. That means the more the capitalized assets, the higher the percentage or the higher the amount. So they'll make sure that as the bank grows exponentially, this amount that has been deposited at the central bank also rises substantially or exponentially. Then we have the asset quality. We know that the bank deals in various assets. There are those that will deal in what we call the bonds, the debentures, some are in money market funds, name them. So the asset quality is generally measured in relation to the level and the severity of the non-performing assets. You could be having so many products, but once you try to market your product outside there, they stop performing. Now we call them the non-performing assets. Let me give you an example with the loans. Before you give someone a loan, they have to show that they have the capacity or the capability to repay that loan. If you are not able to do that, sorry for that. If you are not able to do that, you are at the risk of losing that money. And we've seen some institutions that are trying to, especially the micro lenders, who give out money without necessarily doing what we call Campari. Campari is trying to ensure we have the indicators of telling someone will be able, if we extend the credit to you, and we'll be coming to Campari later on, you should show the capacity. Yeah. Once we are able to ensure that you have the capacity to pay back, of course, the assessment will have to take into considerations your turnover. For example, if it is a business that you are running, what are you able to get per month as your monthly turnover? If you are an employee, what is your disposable income? After we deduct all the deductions in your payslip, what are you left with? And we have what we call the 1/3 rule. You are not supposed to commit your salary to up and including the money that you'll be using for daily upkeep. So you'll be coming to that later on. But what I've said is the asset quality will be, or the severity is dependent on the non-performance. If I give you credit right now, I expect you will start repaying. If you are unable to pay for the first month, I need to understand why. Maybe you are setting your house, you are putting your house in order to start paying. So the banks will give you normally a moratorium or a grace period of like 1 to 3 months. But I expect after the 3rd month, you will have adjusted your financials and you are ready to start paying. If you default once, I send you what we call a local arrears notice to try and understand what is not happening. 2, I'm supposed to understand now by sending you a simple demand. The 3rd letter is not the best because it shows that your account is defaulting for the 3rd month. So as I said in the formal demand, I'll give you some timelines, like you are supposed to repay back your defaulting loan in 14 days, failure to which we are going to classify you with Credit Reference Bureau. Are we there? If again you are unable to do that, I should go ahead and do what we call provision for non-performing loan. And this is what most banks were not doing. So if I give you credit, it is a risk. That's why I'm supposed to evaluate whether you'll be able to pay back, because once the money leaves the bank's account, it goes to the liability side. It's no longer an asset. It's a liability to the bank. You don't know. For instance, so many banks had loans outside there. What happened when you were hit by Corona in mid-March? They had to provide what we call a loan holiday, because most of the people, they are either relying with the employers or payslip, or they were doing business that was not performing. So you are supposed to provide for the non-performing assets. Also from there, you are supposed to provide a mechanism of how you are going to recover. You see, when you provide for doubtful debt, you're already affecting your balance sheet because this is an expense. Yeah. So you will be affecting your income that you had already forecasted. So you are supposed to present what we call a recovery mechanism to ensure that whatever you have provided for has been collected adequately. So most banking system, of course, they are affected because of the problem of now doing the assessment at the initial level. Some customers will come and show that they are able to pay, but somewhere on the way, even the work that I'm doing, it is not secured. I can lose the job anytime. But if I was given that loan dependent on the pay slip, the loan will start defaulting no sooner than I leave my employer. So they'll ensure that the severity is stabilized to an extent that even if the bank was to lose, they are not going to lose significantly. So the rise over the years has been due to, of course, the increase in the non-performing assets, but due to the vigorous standards that have been set by the central bank, they ensure that for every loan that you give, you've provided for default. At least the central bank is able to harness this. Of course, there are also other mechanisms that are being used to detect the asset quality through what we call the improved reporting, and also what we call the disclosure principle. So at one point in time, the central bank might send the officers to do on-site surveillance. And on-site surveillance is coming now to the headquarters of that particular financial institution and demanding to know or to see how the non-performing assets are being catered for. So if your asset quality is good, it means that the level of default will be low and the expected profit will be high. Now, the third one is management soundness. I said managers, they are like the engine. All the other departments of the bank are cogs. So you can imagine a gear system that is unable to jumpstart. So by management soundness, any bank that needs to be outside there should ensure that the board of management or whoever is at the helm is of good corporate governance standing. And I say that because some of the banks like Imperial Bank, if you recall, where managers went and give themselves abnormal loans that they could not be able to service themselves, and even giving some loans without necessarily assessing the risk of whether the loan will be paid back or not. That is what rendered, or that is what made Imperial Bank have a nosedive in its profitability. And momentarily, they were able to meet even the day-to-day operations, and that's why they were put under receivership. Now, before central bank comes in to bail you out, they'll ensure that, and right now, being a manager in the bank is not easy. So the qualitative nature of management becomes very important because these are the people who will be able to judge whether they are on a good or on a sound financial standing or not. A manager at a point in time, because they get what we call the management accounts from the accountants, they are able to detect on whether the bank is performing well or performing poorly. And before even it goes beyond control, they are supposed to harness. Most of these situations are due to, I've said one is due to the asset quality. So they should make sure that the underwriting department or the consumer lending department are well trained, and they can easily detect, even before they offer that loan, they can easily tell the red alarm. And this is up and including doing their field assessment. For example, before I give you a loan as a business, I should be able to send the bank officer to establish whether that business is existing or not. Some people will just have briefcase companies, go borrow with them, and then they go under, wanaenda chini ya maji. So what will happen? The bank will lose. They didn't even establish whether, they didn't do what we call the KYC, know your customer. Knowing your customer is up and including go to their doorstep to check whether they have a physical place. If, for example, they are saying they are doing a hardware shop, a good person or a good bank bank assessor should be able to evaluate how, even by coming to your shop and staying there for only 30 minutes, I should be able to say whether that's a good business or a bad business, depending on the customers that are flowing in and out. I can easily tell whether you are performing or not performing. You should not be coming to the bank to ask for more capital to expand your business if you don't have the customers in the first place. Why are you expanding the business? So management soundness becomes key. Nevertheless, the total expenditure to total income and also the operating expenses to total expenses can be used to gauge the management quality of any commercial bank. I was working in one of the best financial institutions then in this country, and I can tell you, for the bank to remain afloat, we have what we call the cost centers. Cost center is to say, for example, if I have a branch and I've been done a cost center of that branch, as the branch manager, I should be able to make sure that whatever the branch is bringing in a month is able to meet all my expenses, total expenses to up and including paying the employee salary and making profit. If I'm not in that situation, I should report back to the head office in Wambie, this branch is unable to sustain itself. And that's why you see most financial institutions closing their branches. Why? If a branch cannot be able to meet its expenses, then it means that the money must come from the other branches that are performing. So there is no any need of having a cost center that cannot stand for itself. Are you getting? So the manager should be able to set these targets for the various branches. Like I've given you a target of 5 billion loans every month. If you are not able to hit that target, then it means, and I'm saying that because cash deposit, by the way, let me advise you good people. If I have a branch here and I have 1 million customers, and these customers each give 1,000, 1,000, 1,000, I'll be having a lot of money. That is not my money. The bank should at no case think that that is its money. The money belongs to the customer. So one morning, assuming a worst case scenario, if every customer comes for the 1,000, 1,000, and they come 1 million of them, the bank will be left empty. So bank will look into the quality of the assets. They will look into the quality of the asset. They won't look into the liabilities. And I've said customer deposits are liability. So when I'm setting the target, I'll tell the branch manager, I want your branch to give us a target of 5 billion every month. If they are unable to hit that target, I'll know that we are not performing so well. Of course, there could be some macroeconomic determinants or forces that are affecting them, but a good manager should not wait until it is so long, because this is what will define the profitability of that particular branch. If it is unable to perform, we are unable to get the profit, and therefore it means that we'll be sinking or we'll be eating into the already gathered profits by the other branches of the head office. Then you have the earnings and profitability. Strong earnings and profitability profile the bank. It reflects actually the ability of the bank to support present and future operations. If a bank is not profitable, in future, we could be having problems. This could be a point in time. Of course, there are those seasonal issues. For example, Corona is seasonal. Yeah, drought could be seasonal. We could be hit by a drought or an epidemic after some time. Everyone will understand that that is a seasonal problem. But if we are consistently reporting losses, it may mean that we are not strong enough. And this could impact on our operations. So more specifically, it determines the capacity to absorb losses, also finance our expansion. If we are unable to report any profits, how are we going to expand? Maybe we are saying in our strategic document, by the end of this year, we are supposed to have increased our branching by, let's say, 20. If we didn't get the profit in the last year, in the last financial year, where are we going to get the money for expansion? We won't be able to expand. We won't be able to also declare dividends. For example, after the Corona was announced, we know most banks, their financial year ends end of March because they do what we call the quarterly reporting. Some banks, even Equity Bank, they had to withhold. Well, they declared their dividend, but withheld. You see, when I declare dividend, but I don't pay you, it's more or less like I've not paid you, right? So most financial institutions were not able to pay dividends to their shareholders. Now, this one, of course, will affect them, and they'll start detecting as if the bank will be experiencing some financial turmoil. So to ensure that we pay dividends to our shareholders and build up the level of capital or the postulated expansion, we should make sure that the banks are profitable. Now, being front line of defense against any erosion of capital base from any losses should be the objective of any bank. Ensure that their return on asset is well organized. And this one cannot be overemphasized because ultimately, a bank is a business like any other business. And we call it a business because when you inject capital, you expect to get returns on the capital injected. So if a bank is not earning or is not getting any profits, you are not worth existing. And this one cannot be overemphasized. So central bank will make sure, you see, as a financial institution and one of the macroeconomic determinants of our GDP, central bank will ensure that you are performing in a manner that will ensure that the bank profiteers, shareholders profiteer, central bank as your bank profiteers, and the country profiteer. So the expectation has been set so high. Initially, some banks, especially the private ones, used to do misrepresentation of their financials. So they'll declare a lot of profits, but when they go to the shareholders, they don't want to pay dividends. So a shareholder will ask, quarterly, you declared a profit of 2 billion. Where is that money? They'll call that shareholder and tell them, you see, you are trying to build the reputation of the bank because reputational risk can take the bank down. So to ensure that they are looking like they are performing, they used to misrepresent financial statements. So they used to show as if they are performing, but deep down, if you go back in their financial records, the real ones, you'll find that they have a lot of gaps. Some of them used to hide what we call the non-performing loans, and that's why it was so sensitive for central bank to ensure that Camel works. And you can see what happened after Njoroge came into Central Bank of Kenya. A lot has changed in that environment. And we can really tell right now that our financial market is stable than ever. So the fifth one is liquidity. And when we are talking of the liquidity, we are really talking of the movement of cash. Now, movement in liquidity indicators indicates the painful process of trying to adjust and maladjust. I've said the money that is coming in as customers' deposit, that is not your money. Let me tell you what made the US got a financial recession sometime in 2007, 2008. We had what we call the S&Ns, Savings and Loans Banks, where customers or US citizens used to go and save their money in what we call fixed deposits accounts. So if I save money in the fixed deposits accounts, I expect that after, let's say, 1 year, I'll come for my money. Some will go into an arrangement of 3 years, other 5 years. Of course, depending on what you are saving the money for. Some will be saving for a project. So they want, after 1 year, they come to the bank, they withdraw their proceeds and go implement the project that they were aspiring to implement. So there was that saving culture in US because they are disposable income. Now, labor, when you are paid, now their labor rates is incomparable with any other country in the world. Yeah, so if you have some work, you are assured of a disposable income that is attractive. So you got some money that you can save and be left, of course, with the other amounts that will be meeting your day in, day out expenses. People saved, people saved, people saved. Come 2007, towards the end of 2007, some banks came up with what they were calling so you have saved the money, your money is in a fixed deposit account. The same bank came up with some other attractive assets. They were calling them unit trusts. You can Google and know how they function. We have unit trust in Kenya also. But unit trust is to mean, if, for example, I had saved my money in a fixed deposit account where I was earning 5% per annum. So if I save 1,000, if I save 100, let me use 100 shillings, it means that at the end of the year, I'm going to get 105. So I've earned a 5% interest. Unit trust were giving rates or yields daily. So all the people who had deposited their money in fixed deposit accounts in the S&Ls, the savings and loans banks, they came back for their money from the same bank. So you're coming and telling the bank, I need to withdraw my money. There is a good bet I've seen. I want to save it elsewhere. I want to save in unit trust. So people withdrew their money. Let me tell you what had happened. It was serious because you see the bank was holding the money. They know that this money that you have deposited will be payable, will be that person who is using Apple. Yeah, very well. So the money that the customers had saved for, let's say, long term, that is 3 years, 5 years, 10 years, the banks had extended this money to mortgage lenders. And you know, mortgage are long-term assets of the bank. A mortgage can even last for 25 years, others 30 years, other 50 years, depending on the arrangement. So the banks didn't have the money to pay back the customers' deposits. So they were in a situation where the customer needs their money, but the bank has already given that money to someone else to pay it back after 25 years. What do you think will happen? It was crisis. So the banks became illiquid. Illiquid to mean you could walk to a bank, but they don't have cash. So you have to wait for them to borrow or get deposit from the Federal Reserve to pay you. So this happened after a while, end of 2007. It pushed these banks towards mid-2008. We are already experiencing what we call US financial recession. And you know, when the big brother suffers, it trickles down. Of course, that affected the value of the dollar. And of course, it even trickled down. And the worst hit people are now the third world countries. That's how we got the financial recession of 2007, 2008. So from there, they learned a lesson. Federal Reserve declared actually that no commercial bank will be writing mortgages. Loans are drawn, mortgages are written. So they stopped. So if you want to be in the mortgage business, you have to open a mortgage bank. Separate entity from the commercial bank. So commercial bank is for receiving the customer deposits and extending the short-term loans. When it comes to things like mortgages and you want to run a mortgage, should be a separate portfolio. And that is how they were able to harness the liquidity issues. Of course, it will trickle down now to even the third world countries like Kenya. And right now, even the banks that are offering mortgage, they offer it as a separate entity. So you will find Equity Bank. Let me give an example with KCB. We have KCB, and if you work in KCB, they have what they call S&L. S&L is for managing mortgages. KCB is a commercial bank. So for them to be able to offer mortgage, they must come with another separate entity, of course, registered under KCB to handle the mortgages. So liquidity becomes an issue. So the ratio of liquid assets to total assets should be ensured that it's at par. And this was consciously brought about through a monetary policy by the central bank to ensure that both the cash reserve requirement and the statutory liquidity requirement are reduced and they are manageable for every financial institution. Of course, the steps were enforced by decline in the CBK's discount rate to ensure that initially, the more you lend, the higher the discount and vice versa. So they had to undercut this. They also ensured that the treasury bills yield was used to now to help manage the bank's shillings withdrawal and still meet the credit requirements. And of course, this was meant now to ensure that they don't destabilize now the Kenya private sector alliance, because it is also depending on these banks in getting the liquid to run the affairs. For foreign banks, that's for local banks. For foreign banks, they had to undergo through a lot of adjustments, and this was to be done very quickly because their stake was a bit higher, to ensure that they don't decline in liquid assets to their total assets ratio. We know that most of these banks, and they are managed by their parent companies, wherever the country they are operating from, and whatever they bring in this country are only branches. So to ensure that there is growth, the deposits were to be increased and maintained at a certain level. That is Gumbao, who is joining when we are about to terminate the lecture. Gumbao, how are you? Gumbao, how are you? Gumbao. Mutuko, can you hear me? You don't want to talk?
I'm fine.
Why are you late for my class?
Yes, I can now hear you.
Why are you late for the class?
I was in earlier, but the network failed.
Okay. We are about to end the class, huh? So I was talking of the liquidity, and the last one is now sensitivity now to the market risk. Now, Camel is a supervisory system or supervisory framework may fail to provide what we call early detection. And this may not play a vital role in whatever you want to control, like the financial crisis that hit US in 2007, 2008. And we could see in the same period, there were other regulators who began now officiating the stress testing mechanism. But you see, the federal bank could not adopt. You see, federal bank is an independent. It cannot even be advised by US government. It is independent. So there are other players in the industry who can easily help now central bank detect when we have some market risks. For example, in Kenya, we have the other regulators, domestic regulators. And I'll give examples. We have Insurance Regulatory Authority, we have the Retirement Benefit Authority, we have Capital Market Authority, we have SASRA, or the Circle Society Regulatory Authority, we have the Association of Kenya Insurers, etc., etc. All these are regulators. And of course, they have the mechanism, or they have the supervisory framework that helps themselves even detect whether they are performing or whether their products are sensitive to the market risk or not. So the Camel, or the sensitivity to market risk, is not just an aspect of central bank only. It's been spread for a forward-looking, of course, for a forward-looking country. They are going to rely on a lot of information that is coming from the players in the industry. And that is what will help now central bank detect whether there are risks that they are unable to identify at the point in time, or when they are doing the overall surveillance. And this will be provided, all the information is shared amongst the regulators in the industry. So the examiners of central bank, of course, will come into the banking sector and try to do the assessment and try to understand the sensitivity of the market risk through what we call monitoring. But what they are going to monitor are only credit concentrations. And I've said one way of knowing whether we have quality assets is by ensuring that for every credit that we give outside there, we have provided for that risk. It's a risk. We are not sure whether it will be paid back, right? So most of the examiners from the central bank will concentrate on credit risks. So they won't be looking at the other aspects of the market. And that's why there is a need to bring in the other players to ensure that if there are mechanisms or if there is a supervisory mechanism that they are using, they are at par. Now, central bank has really tried, and they have really or significantly expanded their forward-looking supervision approach by providing to up and including, there is this what we call the central bank colleges, where they ensure that we have extensive training, especially to the frontline bank examiners and the auditors. So the internal auditors of the bank, of course, will be called for training. They'll be taken through how they can easily detect risk before it hits the particular bank. So off-site surveillance has been regularly done and analyzed through what we call the CBK colleges. And they have this ongoing. They've also been trying to do what we call the prudential meetings with the management of these financial institutions. So the bank will call the governor of central bank, of course, through the board, will invite all the chairmen of the banks of the financial institutions for a prudential meeting. And the purpose of the meeting is to try and keep them abreast on the new indicators that are being used by the other players in the industry to try and apply or use them in their compliance requirement. And this way they are able to harness most of the risks before they hit them. They've also been trying to meet with the external auditors. An external auditor, you see, I was talking of training the internal auditor. Internal auditor is supposed to value add. They are supposed to ensure that your risk profile is well monitored so that you don't expose yourself to losses or risks. Now, the external examiner is not supposed to do value addition. They are supposed to come and examine, and more importantly, help to process for the central bank on whether you are performing or malfunctioning. Are we together? So at a point in time, now central bank will be expecting now to do the follow-up meetings or the on-site examinations with the external auditors. And the external auditors will not come and laugh with you. I'm talking about, they are professionals. You have the likes of PricewaterhouseCoopers. We have the likes of PKF. Yeah. So we are talking about, we have Deloitte and Touche. These are people who will be sent to come and do now the external auditing on behalf of central bank. So they'll ensure that all the checks and balances, no stone is left unturned. So they'll ensure that whatever they are doing, their scope of external audit, the items that they are checking will really help detect whether there is a risk that is upcoming and unforeseen or unprovided for, and if there are any risks that are forthcoming, whether that particular financial institution is able to cushion itself. So they are very thorough. Then, of course, the exchange of the information with these other regulators now will help now include the supervisory framework into the ecosystem of central bank to ensure that every other player is cushioned. We've also been doing what we call the assessing or the monitoring and management of other credit concentration areas. For example, right now, central bank has ensured that the key sectors of the economy are well funded. And they did this through constantly reviewing their bank lending rate. to ensure that everyone is accommodated. Now, this goes now to the small and micro enterprises, the SMEs. We have the commercial real estate lending, or when you are lending for acquisition or development of a property that will bring in more cash. Agricultural lending. 80% of Kenyan economy is driven by agriculture. Energy sector is also an emerging market, and the government is making sure that any other person who is playing in this energy sector is well funded. We also have medical lending to ensure that we have adequate health care. Yeah. The other aspect of lending is to ensure that even the mwananchi who is below there is well taken care of. So the bank or central bank will ensure that they are assessing or the monitoring mechanism, the credit concentration is going to the right segments of the economy to ensure that we are well funded, our GDP is coming up, and by will become a semi-autonomous economy. Also, other areas that they are going to ensure that they take or cushion themselves from, because now the exposure to this market might lead to more risks. Foreign exchange is an area that also central bank is trying to be keen on, and that's why they are reluctant to allow the fifth evolution of money, or what I call the digital assets, because they know no sooner, and you know Kenyans can be carefree, if they allow people to trade in cryptocurrencies, you will find after 3, 5, 10 years, no one will be keeping their money in the bank. They'll prefer the digital assets because their money is trading daily. So money is giving you returns every day. So they'll ensure that they do that, right? Other areas that they check are the equities, the derivative market, which is not so prevalent in Kenya. But they ensure that they control the interest rate and the credit default of these derivatives to ensure that people constantly now trade in what we call the swaps, futures, forward contracts, etc. So the government, through central bank, is able now to accommodate each and every player in this financial market to ensure that they reap returns or they get the best from the financial sector. Any question? Any question? That's all. That's all. So that is Camel. So I've said if a bank is able now to conform to all this, we expect that after the rating has been done, they'll be having a strong rating. The worst case scenario is having a satisfactory rating. Having fair, marginal, or unsatisfactory, it shows that you are bordering what we are calling risk. You should be at least in the first category or the second category. And I've said all this is controlled by M. And that's why adequacy in the corporate governance in any financial institution is very important to ensure that there is compliance. And once there is compliance, the policies and the procedures will be taken care of. Any question? Are we well? So in the same vein, I want us to go back and interact in the portal. I've realized there are people who are not responding to the discussions. Woe unto you if you are not responding to the discussion. Apparently, it's the only mechanism that we can use to tell the students who are in class and who are not in class. So kindly go to the portal and respond to the discussion forum. In absence of any question, I'll be collapsing this class. So enjoy your day.